My name is Nancy Roberts. I'm an economics professor at Arizona State University. Today's topic is going to be profits. And economists use a different definition of profits than do accountants. When we talk about profits, we talk about positive economic profits, zero economic profits, or negative economic profits. And the reason we make this definition is because as economists, when we talk about costs, we always include opportunity costs. We always include opportunity costs. So when we draw cost curves, an average total cost curve, incorporated into that cost curve is opportunity cost. And so our definition of costs is different, and therefore our definition of profits are going to be different than an accountant. For example, if a normal rate of return in a particular industry is 10%, and I am engaged in that activity, and my rate of return is only 5%, when in fact the normal rate of return, the opportunity cost, is 10%, then I'm taking negative economic profits. So that's the way we consider profits. And so we're going to, when we look at profit maximization for perfect competition, we're going to see this come into play. So let's go back to what we had yesterday, and that was Farmer Brown. Farmer Brown, the price was $2. There's the marginal cost curve. This was his marginal revenue. This was his average revenue curve. And the optimal amount of output for Farmer Brown was Q star. And from this picture, we cannot tell if Farmer Brown is making profits. And the reason we can't tell if Farmer Brown is making profits, because the only information we have is what was the cost of this unit and what was the revenue from this unit. We don't have the cost of all of these previous units. We'd have to integrate under the curve, and we'd have to have information about fixed costs, which we don't have here. So what we need to tell about profits in this picture is we need an average total cost curve. So what I'm going to do, I'm going to change this. Instead of this being Q star, let's just make this 100 units. So let's say 100 bushels is optimal for Farmer Brown. And let's put his, so what we know is that Farmer Brown's total revenue is $200 because he makes 100 units, sells it for $2 a piece. What we don't know is what are his total costs. We only know that the cost of unit number 100 was $2 to make. That was the cost that was added to his total cost. What we need is this average total cost curve. We talked about average total cost in a previous video. And so what we can see is, at the optimal output level for Farmer Brown, on average, the total cost of each of those 100 units was $2. So his total costs are $200. So his profit, I use this symbol for profit because I don't want to write the word out, his profit is zero. Zero economic profit, which is not a bad thing. In fact, this is what we expect to see in perfectly competitive markets. We expect to see the perfectly competitive market always moving towards this position. Because remember, this average total cost curve includes opportunity cost. It includes a normal rate of return on investment to wheat farming, whatever the rate of return is. Farming's somewhat risky because you can't control the weather. You can't control whether or not it rains or the temperature. So the risk reward would be different for agriculture than it would be for paper clips. So this average total cost curve includes all of that. It includes the opportunity cost. This means zero economic profit, which is not a bad thing. It's a normal thing. Okay, so this is what we expect. Next, I want to show a picture of a firm, a perfectly competitive firm. This is Farmer Brown. Let's show Farmer Jones, who also is in the wheat industry. And let's look at Farmer Jones' situation. He's also a price taker. He's one of the 3 billion bushels in the wheat market. So now this is Jones. This is Jones. And Jones is going to sell his wheat for $2. And he has marginal costs that look like this. And his optimal output level would be this. Only let's say 100 bushels as well. Let's look at profits. Let's just put a number here. And we can't tell what his total costs are. His total revenue is equal to $200. We need an average total cost curve, so let's put one in there. It's a U-shaped thing, average total cost. And you can see that at this optimal output level, which is 100 bushels, on average, each of those bushels cost Jones $1.50 to make. So Farmer Jones's total costs equal $150. His total revenue is $200. So Farmer Jones's profit is positive economic profit equal to $50. So that means if he has positive profit, it means he's paid all of his explicit costs, like he's paid for the cotton seed, he's paid for the labor, he's paid for the land, he's paid his tractor bill, and he's received a normal rate of return on investment, and then he's got $50 left over. So this is above normal profits. This is positive economic profit, and you can see the positive economic profit right here. This is it right here. It's 50 cents a unit on 100 units. It's $50. There's the positive economic profit. Okay, the next thing we want to do is, we've seen Brown and Jones. Let's see Farmer Smith, see how he's doing. Farmer Smith is also in the wheat market. He also sells his wheat for $2. Marginal revenue equals average revenue. Marginal costs, just say 100 units. I'm using 100 because it's an easy number to work with. Okay, so we can see Farmer, who is this? This is Smith. We can see Farmer Smith's total revenue is $200. Farmer Smith's total cost, we need an average total cost curve. So let's put one in here. Average total cost. You'll notice every time I draw these average total cost curves, the bottom of them is where marginal cost cuts through it. Okay, well, at 100 units, on average, each one of these 100 units costs $3 a piece. So Farmer Smith's total costs are $300. So Farmer Smith's profit is minus $100. Now, something we need to think about is firms sometimes operate when they're taking losses. Not always. Sometimes they shut down, sometimes they continue to operate. And so what we want to do is look at Farmer Smith's situation, and he has to decide, look, I'm losing money. Should I shut down or should I continue to operate? And the decision is always to minimize losses. Just as the decision, the flip side of the coin, is to maximize profits. Well, if you're going to take losses, you want to minimize them. So what Farmer Smith must do is compare this loss, $100 if he operates, with what he will lose if he shuts down. And so we have to think about what we call the shutdown decision. And something that must be made very clear is fixed costs are irrelevant in the shutdown decision. They are unimportant. Here's why they're unimportant. Because if you operate, you must pay your fixed costs. If you shut down, you must pay your fixed costs. Why? Because you signed a contract, and contracts are enforced. So you have to pay your fixed costs if you operate or if you don't operate. So they're not part of the decision-making process. What you don't have to pay if you shut down is variable costs. I mean, if you're not going to plant wheat, then you're not going to buy seeds. If you're not going to plant wheat, you're not going to irrigate the fields. You're not going to put pesticides and herbicides. You're not going to hire labor to work the fields. So your variable costs are the costs that we're concerned with in this shutdown decision. Does this price cover your variable costs? So what we need to determine that is our average variable cost curve. And in previous videos, we've talked about average variable cost. It's also U-shaped, and it also cuts through the bottom of our marginal cost curve. So let's draw one in here. There's my average variable cost curve. And what this means is when I produce 100 units, on average, the variable cost of each of those units is $1.50. Okay, so we can see our total variable costs at 100 units are $150. We can also see then, this is my average fixed cost, which are $1.50. So my total fixed costs would be this average times 100. So my total fixed costs are $150, which means total costs equal $300, which is what we know to be the case. Okay, if I operate, I'm going to generate $200 in revenue, which will cover all of my variable costs. My variable costs are only $150. I can pay all of my variable costs, and I can actually pay some of my fixed costs. I can't pay all of them, but I can pay some of them. And so if I operate, I'm going to lose $100. The difference between marginal revenue, between total revenue and total cost. If I shut down, so this is if I operate, so my profits, these will be my profits if I operate. I'm going to lose $100. If I shut down, what happens if I shut down? If I shut down, my total revenue is equal to 0 because I'm not producing anything. I'm not selling anything. My total costs, if I shut down, are going to be my fixed costs, which we know to be $150. So my profits, if I shut down, are minus $150. So here's the question Farmer Smith must ask himself. I'm losing money. I want to lose as little as possible. What are my options? Operate and lose 100, shut down and lose 150. Oh, this is a no-brainer. I'm going to continue to operate and lose $100. Then the question then becomes, forever? No. Until you can somehow get out of this fixed contract, or until something changes in the market such that the price increases or that your costs decrease. I mean, maybe your contract says you can sublet. Okay, well then maybe you can get out of this contract. Maybe your contract says you can renegotiate if the price becomes X. At any rate, if you've signed a contract for 3 years and you can't get out of it, then what we say is that you are in the short run for 3 years and you're locked in. And at the end of 3 years, you can get out. So we're going to take a loss in this case. We're going to operate and take a loss. Let's look at a picture of someone who's going to shut down. This guy's going to stay. Smith is going to stay. Okay, so here is Farmer McDonald. Here's my price, $2. Marginal revenue equals average revenue. Marginal costs produce 100 units. So we can see our total revenue, if we operate, total revenue equals $200. Total cost, well, I need my average total cost curve. So it's this U-shaped thing. And let's just say that's $4. So total costs are $400. So my profit is minus $200, negative economic profit. So the question is, should I shut down or not? Is it going to be cheaper for me to shut down or should I stay? And the answer is, we need to see our variable cost. Does this $2 price cover our variable cost? Well, let's put an average variable cost curve in here. At 100 units, let's just say 250. 100 units, on average, the variable cost associated with each one of them is $2.50. So total variable costs equal $250. My total fixed costs then equaled $150. So my total costs equal $400. If I operate, I'm going to lose $200. If I shut down, I have no revenue, but I also have no variable costs. So if I shut down, all I'm going to lose are my fixed costs, and my fixed costs are $150. So the question is, do you want to lose $200 or do you want to lose $150? And the answer, of course, is I'd prefer to lose $150. And so you shut down because it minimizes your losses. Not every producer makes profits. And sometimes the decision is, how much do you want to lose? And in this case, you loss minimize by shutting down. So we can see our profits in a perfectly competitive firm. What I want to do in our next video is generate the supply curve for an individual firm in a perfectly competitive industry.